One day, I was sitting at my desk staring at the charts when it finally clicked. Every single morning at 9:30 a.m., something specific happens in the market. This isn't random, this is engineered. And once you master it, the morning open becomes your ATM. I'm going to walk you through a strategy you are going to love because it's simple, it actually works, and it doesn't require you to sit glued to a screen all day. Just 3 steps, that's it. I'm going to take this strategy into a live market and trade it in real time so you can see exactly how it looks when everything comes together. And stick around till the end because at the end of this video, I'm going to share a bonus tip that most traders completely overlook. It's one small addition to the setup that can considerably increase your win rate. It takes about 10 seconds to apply and it filters out a lot of the weaker setups before you even consider entering a trade. So let's get straight to it. First step, open TradingView. If you don't have it yet, I'll leave a link in the description. Choose any chart depending on the asset you're planning to trade. This strategy works across all markets. Next, make sure your time frame is set to 15 minutes. Go to the time zone setting in the bottom right corner of your chart and select New York time. Now, locate the first 15 minutes candle that formed on today's date. In this example, the first 15 minutes candle that formed today is right here. Simply draw a line at the high and low of that candle and extend both lines in the future for the next 60 to 90 minutes. One critical point to remember, make sure that first 15 minutes candle has fully closed before marking your range. If the candle is still forming, you need to wait for it to completely close first. Now step 2 is where things start getting really interesting, and honestly, this is what separates profitable traders from losing traders. You need to confirm that the candle you just boxed is what I call a manipulation candle. And most of the time, when you're looking at that opening 15-minute candle, it is. I'll explain exactly why in a moment. A manipulation candle is a fast, aggressive move either up or down. Direction doesn't matter. What matters is that it's fast, it's aggressive, and it's moving in one direction. To understand why, you need to understand how billion-dollar institutions actually trade. Because unlike you and me, they cannot simply buy or sell whenever they want. The scale at which they operate creates a fundamental problem. There are not enough buyers or sellers at the price they want to trade at. If a major institution tried to enter a position at market price, the sheer size of their order would move the price against them before they could fill it. They would end up buying higher and higher or selling lower and lower, destroying their own entry levels in the process. So what do? They create the liquidity themselves. Here's how it works in practice. Imagine price is approaching a well-known support level. Retail traders see this, enter long positions, and place their stop losses just below the recent low, the most logical place. The institution, which already holds a position and wants to add more, now has a fundamental problem. There are not enough sellers at that price for them to buy from. So they start selling their own holdings, artificially, deliberately. This drives price down, makes the market look weak, and causes other retail traders to panic and sell as well. Price drops further, passes the recent low, and triggers a cascade of stop losses. Suddenly, there is a flood of sell orders in the market, exactly what the institution needs. They buy into that selling pressure at the price they wanted, fill their entire position, and price reverses back in the original direction. That aggressive move down was never a real breakdown. It was engineered. This mechanism works in both directions. Below a key support level, stop losses from long positions are triggered, creating sell-side liquidity for institutions to buy. Above a key resistance level, stop losses from short positions are triggered, creating buy-side liquidity for institutions to sell. The fast, aggressive candle you see at the open of virtually every trading session is this phenomenon in action. It happens every single day across every liquid market, stocks, forex, futures, crypto, because institutions need to enter and exit positions every single day, and they always need liquidity to do it. Retail traders who do not understand this get trapped by it. Traders who do understand it can position themselves on the right side of the move. To confirm whether your opening candle actually qualifies as a manipulation candle, here's what you do. Switch over to the daily chart of whatever asset you're trading, and add the average true range indicator. Default settings, 14 days, no adjustments needed. This gives you a number. In our example, this is the value. Now, that value represents the average daily range over the past 14 days. Here's the rule. If the size of the candle you just boxed, from high to low, is 20 to 25% or more of that daily ATR, it's a confirmed manipulation candle. So take the ATR value, multiply by 20 to 25%, and you get this value. That's your threshold. In our example, the candle ranges from here to here. That's well beyond the value we calculated. Confirmed. Now, if you're looking at a candle sitting at around that 19 to 20% range, don't stress over it. You can still work with it. But 25% or higher is a dead giveaway. Now let's talk about the entry, and this is the step that ties everything together. Drop down to a lower time frame. I prefer the 5-minute chart, though you can use 3-minute, 2-minute, or even 1 minute. From here, you're waiting for one of two specific reversal candles to appear outside the range you boxed in step 1. This is the most critical moment in the whole setup, because if neither of these candles appears, the move could just continue. 20 minutes, 30 minutes, sometimes for the rest of the day. You don't chase it, you wait. The two candles you're hunting for are the hammer or inverted hammer and the bullish or bearish engulfing candle, and they must appear outside the box within 60 to 90 minutes of the market open. After that window closes, the opportunity is gone. You come back tomorrow. Here's why these candles matter. Take the hammer on the long side. This needs to appear after a clear, sharp red move downward. That long lower wick, that's not random. It's telling you that a massive buyer stepped in and absorbed all that selling pressure. Someone with serious buying power decided this was the price they wanted. And if someone that large is buying into that weakness, the odds of price going lower from there drop significantly. They've announced their intentions. Wait for the next candle to break above the hammer high, enter at the open of the candle after that, and set your stop at the low of the hammer. The inverted hammer works the same way in reverse. It appears after a clear green move upward, with the wick extending from the top. Entry is at the break of the next 5-minute candle, and your stop goes slightly above the high. For engulfing candles, the logic is identical, but the setup looks different. A bullish engulfing fully swallows the previous red candle. I like to set my entry limit order at the high of that previous red candle, so if price pushes up to that level, I'm automatically in, and the stop goes at the low of the engulfing candle. A bearish engulfing works the mirror way. Entry at the low of the previous green candle, stop at the high of the engulfing candle. Now let me show you how this looks in real trading. In our example, the day opened with a strong negative red manipulation candle. So right away, we know we are looking for a bullish reversal below the range, specifically a hammer or bullish engulfing candle. We drop to the 5-minute chart and we watch. Price drops for a couple of candles after the open. It is not ready to reverse yet. But then, roughly 45 minutes after the opening bell, something shows up. Right there, a hammer candlestick forming below the box. We enter at the break of the next candle. Stop goes below the low. And the target profit? The top of the range we drew in step 1. The box actually serves double duty here. It gives us the entry zone on one side and two natural profit targets on the other. The low of the opening candle and the high. The trade was entered here, stop loss set here, target profit here. This is a 1 to 5 risk to reward. The price eventually reached the target, and this setup happens very often. Now for the live demo. It's completely changed how I trade. I decided to trade this on an individual stock rather than the index, because here's something worth knowing. These manipulation candles are often even more prominent on individual stocks than on the big indexes. Indexes naturally carry more baseline liquidity, which means institutions don't always need to engineer these moves quite as aggressively. But on single stocks, boom. You'll see this setup with even more clarity. And these days, the highest volume stock around is this one, so that's what I'm trading. Pull up the daily chart, add the ATR indicator. It's reading this value. 25% of it is this value, so my threshold is simple. If the opening 15-minute candle has a range greater than this value, it's a manipulation candle. Market opens. The stock gaps up slightly and then starts moving south hard. We wait for the candle to close. The range is well past our reference value, so the setup is confirmed. Now I draw the box and I extend it forward. but only 75 minutes out, because after the 90-minute window, the trade is off the table. The manipulation candle was negative, so we're hunting for a bullish reversal below the range on the 5-minute chart. We watch. A couple of hammer candles appear, but they're still inside the range. Those don't count. You need the reversal to form outside the box after a clear directional push. Then price drops further, breaks below the range with a big red candle, continues lower, and now we're watching for the setup. And there it is. A strong green candle starts forming that could turn into a bullish engulfing. I place my limit order at the high of the previous red candle. If price pushes up to that level, I'm in, and it confirms the engulfing pattern. Price continues higher. We're in the trade. Stop loss below the low, target profit at the top of the box. That's a risk to reward ratio of around 2.5 to 1. Price pushes steadily upward. It re-enters the range, a promising sign. We let the trade run and boom, target is hit, a solid trade. Alright, before we wrap up, here's the bonus tip I promised you at the beginning. All I ask in return is to leave a like and write in the comments the city where you're trading from. It takes 5 seconds for you, but it means the world to me. When you are confirming your manipulation candle in step 2, most traders only look at one thing, the ATR. And that works, but there is one additional layer that can considerably improve your win rate, and it takes about 10 seconds to apply. Volume. To add this to your chart, check on indicators at the top of your trading view screen. Type volume in the search bar and select the plain volume indicator, the one listed under the built-in section. No extras, just volume. Once it appears on your chart, click the settings icon next to it. Head to the input tab and make sure the MA period is set to 20. Then go to the Style tab and check the Volume MA checkbox to make the moving average line visible on the chart. While you're there, increase the line thickness slightly, just bump it up 1 or 2 notches so it stands out clearly against the volume bars. That's it. You'll now see a line running through your volume histogram. That line is your reference. Now, here's how you use it. When that opening 15-minute candle closes, before you do anything else, glance down at the volume. Ask yourself one simple question. Is the volume of this candle above or below that moving average line? 3 scenarios. Scenario 1, large candle, volume above average, and price is already showing hesitation on the next candles. This is the strongest confirmation you can get. The volume spike tells you that big players were actively involved in creating that move. The quick hesitation or reversal that follows tells you they got what they needed. The setup is confirmed and you move to step 3 with high confidence. Scenario 2, large candle, volume above average, but price is still pushing in the same direction. Manipulation is likely, but the market is not ready to reverse yet. Do not force the entry. Wait for the reversal candle signal in step 3 before doing anything. The setup is still valid, just not ready. Scenario 3, large candle, volume below average. This is where your volume saves you from a bad trade. A large candle on weak volume lacks the institutional footprint you're looking for. The move may not be sustainable. Treat this setup with extra caution or skip it entirely and wait for a cleaner opportunity the following day. The key insight is this: volume does not just confirm the size of the move, it tells you who was behind it. A high volume manipulation candle that quickly reverses is one of the clearest signs that institutional money has done what it needed to do and is now ready to push price in the opposite direction. Think of it this way. The ATR tells you the candle is big enough to qualify. The volume tells you the right people were involved in creating it. Together, they give you a much cleaner picture of what is actually happening at the open, and that clarity is what separates good setups from great ones. That's all for this video. See you guys next time.